I'll just run through the macro themes before we go into the sector and eventually the stock picks. So for us, our macro theme has been on inflation. The reason we say that is that initially we don't think it's runaway inflation, but inflation is definitely climbing up and it's going to be likely going to be higher than market expectations. And we'll explain what's the consequence. But firstly, you can see that inflation is appearing everywhere. The first one to note is liquidity. So as we all remember, I mean, hopefully most of us can still remember, we had this QE1 to QE3, which is QE basically means now the US, the Federal Reserve is buying treasuries. So you can see it didn't really inject liquidity into the real economy. Most of it was stuck in the banks, as bank reserves, you could say. But this time around, you can see in QE4, I guess, you can see there's a big difference now. The liquidity is really going into the economy, in part due to the fiscal spending. And when money goes in the real economy, that's going to raise a lot of price pressure into goods, commodities, and so forth. So that's one thing that's rising. And you can see inflation, obviously, in commodities. And the worrying thing is that the big spike only happened recently, and you usually get a lag. So when commodity prices rise, like right now, fertilizer price is probably going to surge. You will see that lag only happening, in the following quarters, or directly and indirectly. We also see cost pressures for manufacturers. So you can see that there's a big spike here for the PPI, which is basically the cost that manufacturers are facing, from raw material, shipping, and so forth. Just to give you a flavor, we actually, when we were listening to Del Monte recently in their recent results, they mentioned the cost pressure for them is as much as US 60 million. So in a way, you can say suddenly their costs for goods and everything just spiked up 60 million. So as a result, they had to raise prices. I think almost combined, maybe even more than 10%, because if not, you're going to be burdened with additional 60 million US. Of course, you can have some efficiencies, but this is just to give you a sense, because this is a Singapore company, of the amount of cost pressure that a manufacturer has, and the ability to pass it on to their customers is very key. We of course know the other cost pressure is shipping costs. You can see here it's really up and away. I think container costs per box, that means if you want to ship something from let's say Shanghai to Europe, it used to be maybe 2,000. So right now it's almost 15,000. Probably the spike is even better than rubber glove prices, but it's up almost 7 times. And the worrying thing is it keeps on climbing. We have thought it would kind of stabilize. And the joke in the industry now is that for every shipment worth 15,000, some goods may not even be worth that much. So imagine if your goods in the container is 30,000, now half of the cost is going to come from shipping. There is a longer term repercussion of this, is that if this continues, you could actually see manufacturers shifting more towards parking their manufacturing base out of Mexico, into US, because if it's so costly to ship anything, you might as well just produce it in the end market. I mean, hopefully it doesn't come to that, but I think some supply chain companies in the some manufacturers and the supply chains are really kind of discussing. I mean, should we eventually have to ship to the closer if the container rates do not kind of stabilize to these levels, because it is just too costly. So that is the longer term worry. Of course, we don't see right now, but that's the thing that we worry most. And we've only give you 4 charts here, but you can see price pressure in wages, even cotton has also hit record high. So there's cost pressures in rentals also rising. So we're just showing you a few items that's rising, but there's many more. But I guess everyone gets the message right now. Okay, so what's the implication of this? So what we think is that interest rates there's upside risk to interest rates. We use a simple chart. What you can see from here, the blue line is interest rates. So interest rates used to be more than inflation, which obviously it makes sense. I mean, we want to get a real return. So if cost is rising by, let's say, 2% every year, we obviously want an interest rate of maybe 4%. We need to get a return, otherwise we're not earning anything. There's no real return from the interest that's being paid. But you can see recently when inflation spiked up, although everyone supposed to be transient. But if this continues, I think we worry that the market is probably underpricing inflation, and we think that the likely scenario is that rates is probably bottom and is going to be climbing at least the next 6 to 12 months. So that is the one macro scenario that we are looking at, which is rising interest rates. By just looking at this chart, you know that it cannot continue to be below the level of inflation out there. Okay, so that's our theme, which is on inflation and that rates will be rising. The other theme that we are looking at in terms of investable themes will be the reopening. Although right now it doesn't feel like there's an improvement in the reopening situation. And hopefully 12 o'clock there's some changes there. But if you look at on a global scenario, we are still confident on the reopening theme, and we're still sticking to our view that we should be investing in a reopening theme. As you can see, this is the vaccination rate. I know there's a lot of numbers here, but if you extrapolate it, again, this is a statistical computation. This is not, you're not using medical here to kind of compute what is the vaccination, but right now, global vaccination rate is about 30%, about 38, 40%. We think we could have a very high global vaccination rate even by next year, even by August of next year. And again, all the developed countries are already approaching 60 to 70%. So with this high level of vaccination, it just gives us confidence that the reopening trade or the reopening trend is still on track globally. And the other thing to be at least hopeful of is the global COVID-19 cases. Although the blue line is the number of new cases, although it's not dropped to the new low, but I think the good thing at least is that the mortality levels is actually to a new low, and hopefully that's because of the high vaccination rates. So that also gives us another confidence that cases globally are trending down lower and quite sharply lower, and we think that that is another reason why we are confident that the reopening of borders, that trend will continue. Just one last one here. So the lockdowns do have a major impact on economic activity in Singapore. I know the lines are all over the place, but just to show you that during circuit breaker, this is a Google mobility. So they actually track the number of people going out, the number of people going to malls, number of people going to work, the number of people sitting buses or even trains. So you can see that when circuit breaker hit, there was a huge collapse. Basically, everybody stayed at home and went to Sheng Siong and shop. Then what happened is that when we relaxed, things were improving. We were actually quite confident here. When we did our FY21 first quarter strategy, we were very hopeful that the reopening will happen. But then, of course, in May, which also coincided with the peak in the STI, when they announced phase 2 HA, then activity collapsed again. It improved as we relaxed, and now it collapsed, and now it's improving. But this drop that you see here is basically the recent restrictions. But I guess if there is a positive here is that each time we drop, I think that the activity continues to improve. So that's why we are hopeful when things reopen, we can get this huge gap up again. But this is just to show you that, which I think we all know, but just to put it in data form, that whenever there's a lockdown, there's definitely a big hit to an amount of people shopping, working, and also moving around. And this is my last slide here. The reason why we just popped up a valuation here is just to show you firstly, in terms of the valuations of the market right now, we are about 14 times PE. And this is just to show you, okay, we are 14 times, but how does it compare with interest rates which are so low? So we're also trending around the average levels. But for us, the point here is that the valuations are fair, but there is optionality because the market hasn't priced in a big reopening. And if we do get a big reopening, we think the valuations are very attractive right now because it's still at historical levels without pricing in a reopening. So, and if a reopening does happen, you're going to see earnings forecast jump, and hopefully the market will also react to it. So we're just saying that we're buying the market now without pricing in any reopening of the borders, and that will kind of stimulate the whole Singapore economy. Yeah, that's why we came up with a valuation chart, strangely, at the macro themes.